All right, guys, so we'll have some fun here, making mistakes with Fib. This is going to be a short presentation. Dave likes to keep it right on track and keep the information short and tidy and to the point. So we're going to be moving. We're going to be talking about live trades. Guys, I'm a live trader. I'm doing it the entirety of my career, even before I got out of college. So if you're newer to trading, I know what you're going through. We've all been there. And if you're a little bit more accomplished in trading, you remember those days. So we're going to be talking about live trading. Don't be trading money you can't afford to lose, because you won't win. If you haven't accepted the risk on every single trade before you go in, you're not going to see your trade plan through to completion, okay? And as Dave said, you will lose money in the beginning. It's like a boxing match. You're going to wind up on your butt several times, try to win the decision at the end of 12 rounds, never go for the knockout punch. That is trading, okay? So let's talk about kind of anticipating entries. I think one of the best ways to become a better trader is to anticipate entries rather than react. And not to pick on indicators at all, but I kind of think when you're trading with indicators, it puts you in a little bit of a reactionary point of view. With Fib, you know, there's a lot of kind of steps to it, and it can seem a little confusing at first unless you've received some training. But once you've got to that point, you can start to anticipate your trades hours and days ahead of time, and a lot of good things happen with your trading when you start anticipating rather than reacting. So I've been only trading for, what year is it, 2017. I started my first trade in '99, so I've been trading for 18 years. My first job out of school was a professional trader at a proprietary firm in San Diego when I was 22. I guess I'm 38 now, so I've been trading for 16 years as my job, and I'm proud to say in my whole career this is the very best that I can present to you in terms of an effective game plan, right? So Fib has really done amazing things for my trading. So let's talk about anticipating trades hours and days ahead of time. As I said, that will help you contain your risk. Now, to pick on MACD, which is an indicator that everyone knows, everyone uses, the signal here is when the black line closes above the red line, right? And that's going to get you in this QQQ trade, very standard entry at 108 bucks. If you take a Fib zone entry, which is something that I can teach you, and in fact, I'm going to give you an entry today, a 2 Fibonacci tool setup, and hopefully I can get that done in 30 minutes, that's going to get you involved down here at about 104 bucks, and that's a standard entry. Guys, do you see the difference, the profit potential you're giving up, getting in at 108 compared to 104? And a newer trader's like, oh my God, I'm missing $4 of profit. Well, I've been around the block, and some of you have been around the block too. I look at that as $4 of increased risk. And the best way to become a better trader in the shortest period of time is to decrease the average size of your losing trades. Nobody likes to talk about, hold on, easy PowerPoint. Nobody likes to talk about, you know, the possibility of a loss, but I'm telling you the very best way for you to improve your trading shortly is to work on being wrong for less. Okay, the way you do that is by anticipating your trades. I don't think you can hear this. You know, I'm going to play for 30 seconds.
Because 3 months ago, you said that oil would fall to 26 bucks a barrel. Listen to this. I think you guys are going to be shocked to hear this. Technicals say in a good, solid pullback, we should see an equal leg push in the current move lower. A 77% drop from the reactionary high up at about $114 puts us at $26 in the crude oil market.
All right, fast forward to last Thursday, oil fell as low as $26.05. Todd, why were you off by a nickel? I'm kidding. I'm just joking. So now that you...
So that was kind of a fun time. That article or that story went viral, and that was the #1 article on CNBC.com and Yahoo Finance. So that was cool. So I was actually the guy who called the low on CNBC in crude oil. People are saying it was going to go to $10 a barrel, $5, $1 a barrel, and just through 2 simple Fib studies. This is the actual chart that I put out to customers. Like the low should be around 26 bucks, and it was just simple Fib that you guys can do inside of like no time at all. Okay, so you can predict longer term moves with this. Real quick, I am Todd Gordon. If you don't know me, I run tradinganalysis.com. I left Wall Street in 2010. I drive my wife and kids insane at home. I trade out of my home office. I'll kind of skip the Donald Trump stuff. Long story short, he was at our wedding reception. That's my best man, Jeff, skewering me like best men do. The president knows all the bad crap I've done in my life. He might deport me. He was like shaking his head in the corner saying, what a wild man. So that's all I got for that. I've been doing CNBC for about 10 years. I run the research business from home. I trade every single day. I love trading. I love working with new customers who are interested in it. It's a slightly different kind of approach to the markets. You really got to like enjoy working with the charts, and that's what we're doing. So it's all about anticipating rather than reacting. I've already said that a few times. So I really want you to drive that point home. So it's about trading from a position of strength, right? Again, I'm going to pick on MACD. When you take a MACD entry up here and the market comes down against you, and you don't really think about Amazon dropping 15 bucks against you, you're going to kind of freak out a little bit. And you're going to say, uh-oh, what did I do now? Why did I follow into that trade at a bad time? You're probably going to eject and close the trade at the worst time when it feels the worst, and then it rips to the top side. So everything that I'm talking about here now is to push your entry deeper into support for longs and higher into resistance for shorts. If you have a good entry, it gives you options. So when the market comes back against you, and it will do that, if you're long from 740 and the market's 735 and you anticipated this, you have a clearly defined stop, you're like, that's fine. I can deal with this. I'm not going to make a bad choice and eject from the trade, and you know, you're going to enjoy the profits on the upside. So I like to use Fib for this, okay? So some of the objections to Fib, and how many of you are thinking like Fib is too difficult, or, you know, how do I start and stop the analysis, all these 50 lines on the chart, how do I know which one's going to do anything? They're all confusing. I think that's completely correct. So on display in the Louvre in Paris, France, is this scroll, the Fibonacci trading scroll, passed down from ancient Italy, 14th century. No, I'm totally lying. But this is a 6-step process that I'm going to give to you right now about how to trade a trend, how to use a trend pullback strategy using Fib that you can start applying in tomorrow's market. Okay, so number one, and again, I'm on full screen. I don't have the questions up. I hate to not address your questions, comments, insults, whatever you guys have. So if you're writing something to me, I'm sorry, I'm on a mobile setup and I only have this one monitor, so I can't see the questions. Don't think I'm being rude. So number one, we got to talk about swing waves. So how do markets trend? How do they correct? You know, where do we start and stop the Fib? And it's all defined with these swing waves. This is an indicator that I've built. It's super simple, but it's just kind of a visual aid. If you have a high bar in the market that is not exceeded in 5 bars to the left, 5 bars to the right, okay, it's a swing wave high, the software paints a purple dot on it, and that's a minor swing wave. So if you have a high or low in the market that is not exceeded in the 5 bars before, 5 bars following, it's a purple dot called a minor swing. A major swing is the same thing. It's a high, or it's a low or a high in the market that is not exceeded in 13 bars before, 13 bars following. This is a more significant turning point, and that's called a major swing wave. So when you look at my charts, you're going to see these purple and blue dots on them, and they're just simply the minor and major corrections. Okay, the minor swings, the major swings, and those are going to be just very quick visual aids to help you figure out where the most prominent turning points are in the market to help you determine if you're in a trend or a correction. And remember, the setup I'm teaching you right now is a trend pullback trading strategy, so you got to figure out what the trend is, where it begins and where it ends. It's just a very quick way just to visually see the move you need to study. So the way I look at the trend, being that this is a trend trading strategy I'm teaching you, you just got to find a very easy way to determine the trend of the market. And those of you who are like a little bit more advanced, you probably can just look at the chart and say, it's a downtrend. It's pretty obvious. But if you need that visual aid, there is this indicator that I do use called the DMI Oscillator Directional Movement Indicator. Wells Wilder invented it back in the 50s. Still very applicable today. And I like to switch the defaults from like 10 to 12, which is your default DMI settings. I like to bump them up to 55, and it kind of smooths things out. If the oscillator is below 0, you are in a downtrend. You got to be thinking shorts only. If you're in a blue oscillator situation, you're in an uptrend. You got to be thinking longs only. Okay, so that's your trend determinant. So altogether, you've got the purple and blue dots to give you the minor and major swings, and you have a quick trending indicator. If you want to throw ADX on there, this is the strength of the underlying trend. You can. It's not critical. Okay, so let's finally get into this. So we have two tools. This is Google 60-minute. You've got a blue oscillator situation, so you're in an uptrend. You've got to be thinking longs only. All right. So now the way you find the most recent and relevant trend swing is look for the most recent blue dot, and that's right there. Okay. The blue and purple dots, you'll notice, are lagging indicators. They happen only after 5 bars after a swing point have closed and 13 bars after a swing point for the majors. So it's a lagging indicator, but that's what you want to do. You want to look at past price action to help figure out where the current market might go. So we're going to look for the most recent blue dot low when you're in an uptrend, and then just simply find the highest price following that blue dot low. So you got blue dot low up to the very high. This is the most recent trend wave that you will use for fib calculations later on. Okay, we're in a downtrend here. So you've got blue dot high to blue dot low against the DMI downtrend. DMI's in red, so we're in a downtrend. Blue dot high to blue dot low is trend swing number 1. The trend is interrupted because it's capped with these blue dots, and then we're going to go blue dot high, blue dot low. That's trend swing 2. So the overall trend direction is down, but there are 2 separate trend swings on this chart. Okay, you can also use them for corrections, right? So if the market is in an uptrend like we are in Amazon on the 60-minute, if you have a blue dot high to blue dot low, that's a counter trend correction. So the trend is up here in Amazon on the 60-minute. You've got blue dot high to blue dot low, blue dot high, blue dot low, blue dot high to blue dot low. So you have 3 separate corrections. You're going to use these past swings to project where the market's going to go in the future, and that's going to offer you an entry. Same thing, this is Google, 60-minute, red oscillator situation, we're in a downtrend. Blue dot low to blue dot high is a rally against the established trend, so these are 2 corrective swings against the established downtrend. So like, what time is it? 13 minutes into a Fibonacci presentation, we're going to get into our first Fibonacci tool. But I think you guys can kind of see, like, I took a lot of time to introduce these 2 tools, but these guys are going to help reduce a lot of the subjectivity of fib and make it pretty formulaic. So here's blue dot. Here's the oscillator in an uptrending situation. We want to find the most recent trend swing to apply the first Fibonacci tool, which are called retracements. And what retracements do is they help figure out how much of a prior trend will be recaptured, offering you longs. Okay, you're thinking longs only when the oscillator is pointing up. So you look for the most recent blue dot low, there it is, and you're looking for the highest price following that blue dot low, and this guy is turned into a blue dot, so that means we have 13 bars off the top. And these certain percentages are possible pullback zones to offer you lower risk, higher reward entries. Okay, and these are your Fibonacci ratios that you're going to use. Now, one quick note, there's 4 ratios here. Like, how the heck do you know which one is going to hold? Well, you can't. Okay, there's 4 possible stopping points you can't know, so you have to add fib tool number 2. That's going to allow you to start what we call stacking the zone, which is like giving you specific areas where you expect the market to reverse. Okay, so before we get into that, let's just kind of take a look at this. So this is Amazon on the 60-minute. What's the trend? It's up. Where's the most recent blue dot low? There. Okay, so we're going to start the retracement from low all the way up to the high, right there. Okay, so on Thinkorswim, this is what I use to build the presentation. You go down to retracements. There you go. You click the beginning of the trend first, the end of the trend next. There are your possible pullbacks. Now, usually I take some time to do some live examples. Let me just see if I can do this without breaking my computer here. And I'll just do some quick fib retracements, and then we're going to move on to the next slide. Oh, there's all my trades. Charts. Okay, and let's go style, load style, and I have it saved. Power wave, there we go. Okay, so Ford and GM did not do very well today, so let's just draw a couple quick fib retracements on these guys. All right, scroll. Sometimes Thinkorswim drops you back in time for some reason. Okay, so Ford, huge miss. Let's get down on the intraday. Let's get down to a 60-minute. All right. Where's the trend? It's down, right? Okay. Oops, come on back, come on back. There we go. In fact, let me get to a better time frame. 95, there we go. Okay, so where's the most recent blue dot low? It's going to be right there against the downtrend. So we're going to hit drawings, retracements. You're going to go blue dot high down to the absolute low. Okay, for this swing, you can see Ford went right up to the 38% and dropped away. All right, let's look at let's see what Tesla's doing. Okay, we're going to find the most recent blue dot low against an uptrending Tesla. So you hit drawings, retracements, high or low to high. Let's take a look at SPY. We're in an uptrend, a moderate uptrend in the SPY. There's the most recent blue dot low. You click once, up to the top. Now, the zones that you're going to use to enter are between 38 and 78 retracement. I don't enter retracements shallower than 38% or deeper than 78. That's your buy zone. The biggest part is waiting for the markets to pull back, okay? Now, all right. Let's get PowerPoint back up. You've got to wait for the market to retrace, and that's going to help you reduce your frequency of trades, your occurrence of trades, which keeps your commissions down, which keeps your entries competitive, which keeps your risk low, and that accomplishes exactly what we're trying to do, which is minimize the size of our losers. We want to be the smallest loser we can. All right, so let's go to fib tool number 2, and this is how we start stacking the zone. Retracements, what we did was we studied the prior trend wave to figure out where this ongoing correction is going to go. That's retracements. Now what we're going to do is study projections. A projection is going to look at a prior correction and apply it to the current correction. So the depth of a prior correction will have an impact on how far this current correction goes. Guys, I think this is more powerful than retracements. So the 100% is probably something you've heard of. It's called like a measured move or an AB equals CD or two-step or symmetry or anything like that. So what that means is if this was a $3 drop against the established uptrend, watch that $3 projection because you're going to see some activity around there. And sometimes the corrections will stop right at that $3 movement, and that's awesome. If the perfect measured move doesn't work, you've got 61%, which is less than a measured move. You got 1272, 1618, and these are all possible comparisons of prior corrections. Now, how do you know which corrections to use to apply to your current correction? Just look for the blue dots. Look for blue dot corrections against the established uptrend. And what you're going to do is look for all the corrections in the trend that you can project off this current move and figure out how far this guy is likely to go. Okay, and what you're doing now is you're going to combine retracements and projections to start stacking the zone. Stacking the zone. All right. Fib on a 15-minute S&P futures. What's the trend? You guys know right away. It's down. Where is your most important corrections against this downtrend? Hint, they're capped with blue dots. So you have a blue dot low to blue dot high. There's one. That's purple to blue. That's no good. Here's blue to blue. There you go. Purple to blue, no good there. Purple to purple, no good there. Purple to blue, no good there. So there's two separate corrections that you're going to look at to help project how far this correction is going to last. So what you do is you go drawings down to Fibonacci extensions. Now just a quick word, Thinkorswim mislabeled these. They're not actually called extensions. They're called projections. That's why you hear me refer to them like that. Charting companies like mess up the names of Fib, which makes it more difficult. Okay, if we don't have a naming convention, so just keep in mind they're actually called projections. So it's a 3-click process. You click the beginning of this correction, you click the end of this correction, and you click a third time off this low. So your 100% measured move was at 2148 against 2141 low. So it's 7 handles in the S&P. That's your measured move. That means that was a 7-point move. You can see it actually didn't hold as a resistance, but it actually did hold as support, and then we moved up to the 1.618. Okay, then you have this correction. I'm going to leave the projections from this little correction here in red, but you can also do this blue to blue right here. There's your measured move. So the 100%, the depth of this correction, which whatever 2153 subtracted from 2141, so it's 12 points, that is a 12-point measured move, and you're also going to use these fib projections, and you can see how you're starting to stack a little bit of a zone to say here's where resistance might come in. So let's look at a live chart. I just want to show you how to do this live, and then we'll come back. There's actually a really nice setup here in the S&P, right? So I'm going to leave the retracement. You know, let me get rid of them just to keep things simple for now. And not only am I don't usually do this on a Mac either, so I'm like stacking the deck in my favor, but I'm up for a challenge. Remove drawing. There we go. Okay, so we're in an uptrend. You got the DMI heading up in the SPY. You go drawings, down to extensions, which you now know are projections. Where's the most recent blue dot high to low correction against the established trend, which is up? It's right here. Boom. Hit once. You click twice. And then you project off this high. Your zone that you really want to be focused on is anywhere from 61 down to 1272. Now I'm going to skip ahead just because we're on a tight schedule, but here's how you get some pretty awesome entries. Remember, we've got to do the retracements. You go blue dot low up to the very high, and you see how we're going to start stacking the zone. We're going to look for confluence. Okay, you're going to look for confluence between the two. And there's a little bit more work that I would do, but there's a pretty good little zone right here. I see a 38%, I see a 618, and I see a 50%. Tomorrow and in coming sessions, you're going to want to watch in the SPY 236.77 to 235.91. That's going to be a really good little zone, okay? And we're going to do a few more examples on here, but let me just see if I can come up with another quick one. Netflix, exact same thing, drawing extensions. We're in an uptrend. Where's the most recent blue dot to blue dot? Right there. Blue to blue. Click once, click twice, click off the top, and you're waiting for some of these projections to come in. You're going to stack the zone with retracements, and that's how you start getting some really, really tight zones. Nice little level at 151 to down to 150.25 in Netflix. Okay, but I want you to use a few more corrections to start to stack the zone. I'm just showing you one just to show you how the tool works. So guys, through those retracements of the most recent swing, through a projection of that correction, a projection of this correction, do you see the zone that you're starting to build? You have a zone from 2152 to 2156. If you're an S&P futures trader and you want to scalp this all day, just sell every rip up into the zone, perfect. If you're an options trader and you want to sell call credit spreads above here, or buy put debit spreads out of here, or just buy puts against that zone, you can do it. However you want to trade it is fine. But that's really important information to know. You've got 52 to 56 zone of resistance in the S&P because you're studying this swing, you're studying this swing, you're studying this swing to help figure out where resistance is going to fall in. Okay, this is a live trade.
You have a pretty good resistance zone
Quiet
in
time.
wave 5.
So this is just a live trade I did. I just did it on YouTube. I kind of have some fun with YouTube. We have fib support right here in the GDX, 29 up to 32, and actually was really high implied volatility at that time. So those of you who are options traders, I did an iron condor with positive delta. I did a 28, 29.5, 31.5, 32.5. Took in 78 cents. I did a 15 lot, executed it live. Trade worked for like a couple weeks. I sent the trade alert out, and it did ultimately hold the zone of support and went up into the resistance. I'll skip the little movie for you. Okay. So that's fine. So you can obviously you can trade with this stuff. You can trade options. You can buy options. You can sell options. This is kind of a fun trade. I should probably get over it, but this is like one of my favorite trades. It's like near and dear to my heart. So you can also use options for counter trend trading. In GMCR, Green Mountain Coffee, the stock went from 160 to 40. The stock was getting crushed. So I was like, all right, you can counter trend trade with this stuff. And I came up with a fib zone of support from retracements, extensions, projections, and expansions. And if you notice, those of you who use Thinkorswim, you'll notice that little icon there, whatever it is, means earnings. So we gapped up on bad earnings from fib support. And I was like, ooh, mwahaha, it's time to go to work. So we put a pretty aggressive option strategy on, which is called a bear call ladder. Basically, you sell a call credit spread, and then you finance the purchase of a higher call. It's a really aggressive trade. Either the stock needs to go bankrupt or a lot higher, and you'll make money. If it goes sideways, that's when you get hurt the most. So the reason it gapped up on bad earnings right here this day was because it was about to get bought out. And we got lucky. I had all the clients in. I did a video the week before. It was cool. This is not something I'm going to be able to replicate in the future, but the calls that we bought for 85 cents or 85 bucks went to $3,200. So you bought 85. If you bought one option contract for 85 bucks, it went to $3,200. Like, I had clients who tripled their account overnight. It was awesome. But it was, yeah, again, lightning struck there. Can I do it again? Probably not. But you can counter trend trade with fib, and that's kind of my point. So the distillery. So I actually invested in a distillery from the profits from that trade. So I took profits from our coffee trade and put it in the spirits industry because craft spirits is actually booming right now. And if trading doesn't go well, I'm always going to have product to drink. Just kidding. So anyways. So it's about reacting. It's about like not reacting. It's about anticipating entries. Okay. I just think if you're following these indicators around, man, it's hard because you're reacting to these indicators as just like everyone else, and these indicators are reacting to price action. Like everyone's looking at the same setups. Like I don't know how you make any money if everybody's doing the same thing, right? So I think you got to really roll your sleeves up. If you enjoy working with the charts, then you can get some pretty good stuff done.